Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah. Well, it's Friday, and we're together, and we've got our listeners, and I always enjoy it, Jim.
Bob, we have a number of listener questions this week, so we'll wade right into them. The first question comes from Justin in Berkeley. I guess he's listened to some of the questions from Kathleen, who likes to make musical references to the markets.
Yep.
He says, Bob sent an update recently with a hat tip to Doris Day's version of The Party's Over. He should make a bear market classic playlist for Spotify with the additions of Que Sera Sera by Doris Day. Is That All There Is by Peggy Lee? It Never Entered My Mind by Miles Davis. On a more technical note, what is Bob's read on credit spread duress? Is it showing breakage signs?
Yeah,
I think that's Miles Davis, isn't it?
Yeah, the trumpet guy. He was superb trumpet.
Yep.
Guy. So, anyways, yeah, the credit spreads. The spreads were likely last year to narrow into around May or June. That's a seasonal move on those, and of course, spreads is the difference in yield between high grade and low grade bonds. And then they turned to widening, and we'd say it reversed the trend. But nothing dramatic happened. And 5 or 6 weeks ago, there was a bit of a spike in widening spreads, and then it backed off. But in this week, spreads, we use the CCC one, which is about as junky as you can get relative to treasuries, and it's close to breaking out from the previous high. That was the main conclusion from it. So nothing dramatic yet, but what happens in a financial mania like we're in, the market is buying bonds like crazy and reaching for yield, so they're buying junk. And of course, corporations is just a wonderful way to raise cheap money. So a bond mania has been part of every great financial boom, and then it all goes bad. They find that there's more debt issued than the economy can service. That means like individual companies are unable to service the debt that they've taken on. So we watch the spread very closely, and it's not, well, in China, junk bonds are under huge duress, but the crisis is only beginning to arrive in New York recently, and probably within a few weeks that spread can break out on the chart, which would be very concerning. So thanks for the question, John.
Question from Robert. Hi, Jim and Bob. Recently it was suggested that China could have a negative effect on the U.S. dollar's role as the world's reserve currency if overnight, for example, the dollar was no longer the world's reserve currency. What would happen to the markets? Would there be a safe investment? If so, what would that investment be?
Well, I'm not going to answer that one because there is absolutely no way that China would ever end up hosting the world's reserve currency. It's not a government decision. It's the financial market and financial history that determines which market and which country hosts the financial center as well as the senior currency. And you can go back to 1500s when Holland, particularly Amsterdam and then Antwerp, and then Amsterdam, were the world's financial and commercial center, and huge. And then in the 1700s it shifted to London, and then with sterling as the senior currency, and then the 1930s you could say it began to shift to New York. So no, the market determines which is the financial center with the reserve or the senior currency. It is New York, and it is the U.S. dollar, and the notion that China would be the host is quite, I think, improbable.
We have a question from Willem Grooters in the Netherlands, and nice to hear from you again, Willem. There's a lot of talk that the 40-year period of falling interest rates has come to an end. Is there a reliable sign that this period of falling rates has ended?
Yeah, it's best to look at the real long interest rates adjusted for inflation, and they declined quite sharply with the financial mania or financial bubble, let's call it that one, in which they have done. The U.S. it got down to almost 6% minus on the real yield, and it's starting to turn up. So in a post-bubble contraction, the long rates for junk and corporate bonds, and there's many investment-grade corporate bonds turn into junk. So then there's, as I said in the previous question, there's an inability to service debt. So the prices get marked down, and we're in a period already of where lower grade bonds are rising in yield, and the long dated treasuries in the U.S. are no longer going down and have risen quite a bit so far, but haven't really broken out yet. But yeah, and then this was also part of a secular decline in interest rates that began in the mid-1940s, and you had the long rise in rates began in the mid-1940s, continued to the commodity blow-off in 1980-81, and then you've been in what we've called a new financial era, where the inflation is in financial assets, particularly stocks and bonds. So this has been the main feature on lowering interest rates. Has not necessarily been the Fed. It's that it's been party time for bonds. But I think the party's over. So then we're going to get a period. Well, it's already started, but the rise in interest rates can be quite substantial, and the trend is already hugely up in China, for example, and just beginning to rise in the U.S.
A couple of questions from Michael. Hello, Jim and Bob. It seems the emerging narrative in the financial media is that the Fed wants the markets to correct with estimates of either 10 or 20% via the use of quantitative easing and higher short-term rates. The narrative asserts that this will cap inflation and force the working class back to work. Well, according to U.S. statistics, they're at maximum employment already at about 3.9, less than 4% unemployment. Once accomplished, the narrative goes and the Fed can turn on the printing press again and restart the wealth effect via trickle-down economics to reignite consumer spending so as to foster economic growth. Bob, is this approach based in credible financial theory, and what are the odds that this approach can work going forward? And his second question, at what point are the markets in the overall topping process, and is now the time to start shorting the rallies and instead of buying the dips?
Yeah, the notion that the Fed can control the economy and control the financial markets is just a notion. It's never worked because when the Fed was being formed and it opened its doors for business in January 1914, the theory was that with the Federal Reserve as the lender of last resort, there would be no financial crisis. Now, the reason why they did not want to have a financial crisis is because the establishment then knew that you have a financial crisis that was followed by a recession. So the lender of last resort theory is that by acting appropriately, the Fed would prevent a financial crisis and then prevent the recession. So then you take a look at the National Bureau of Economic Research, the NBER, which is the semi-official body that determines the business cycle, and there's been 18 cyclical recessions since 1914 when the Fed opened its doors for business. And it only would take one to disprove the theory. Two really disproves it. 18 says it doesn't work. So the idea remains in the establishment, but it's never worked. And there's a wonderful editorial in Barron's, the financial newspaper, from July 1932, and it points out that every anti-deflationary measure taken by the Fed is not working. And the anti-deflationary measures was buying bonds out of the market. So now here we have it. The street now firmly believes that the Fed easing through buying bonds out of the market is, but they're going to, well, the theory is that they're going to tighten a little in here and cool the boom a bit and then turn things on again. But no, it's not going to happen. The Fed does not control the major changes in interest rates, and the work I've done shows that at major turning points like 1929 or whatever, and since the Fed is about 4 to 5 months behind the change in the T-bill rate. For example, in 1929, with the boom, the T-bill rate went up to 5% in May of 1929, and then started down, which was signaling the boom was over. And then the Fed lowered rates in October. So, no, the Fed on the serious financial market cycle, credit market cycle, interest rate cycle, whatever you want to call it, doesn't control the market. It is behind the market. So what could happen here is that, as I mentioned in previous questions, long rates have probably started a significant uptrend that the Fed can do nothing about. Michael had a second question. At what point are the markets in the overall topping process, and is now the time to start shorting the rallies instead of buying the dips? I think an important top is in. What counts now is when this market, the stock market, finally stabilizes and does a bounce, and we'll just see how far that goes. But yeah, the action is changing from, well, we actually have a technical model that we call it buys the dips, but we call it the springboard buy. And so it comes in usually at tradable bottoms where one can buy. Now, in a long bear market, this changes to where it becomes sell the rallies. So it's the opposite to the springboard buy. So, it's the appropriate strategy, but one wants to wait and just see how far there will be a rebound out of this latest hit, and the key will be is how far that one gets. Thanks for the question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Some headlines that caught Bob's attention today. Tanker bulk shipping LNG shipping rates plunge. I thought the world wanted LNG.
Yeah, these are shipping rates. And we noticed last, I guess it was early October, when the one that's been around for a long time, and you can get a chart on it, and that's the Baltic dry freight rate. And it had gone straight up into early October, became very overbought, and then it's gone straight down. Well, more or less straight down, you know what I mean. And the last time it did the same technical at the top was in 2008. And then it went straight down for quite a while. So and as the article points out, even liquid natural gas shipping rates are declining, but tanker rates are still high. Container rates are still high. But what gets interesting, Jim, about the Baltic is that I think that the peak was in June 2008, but the recession in the U.S. had started the preceding December. So there was a 6-month lag, you can say. And so the instruction from this straight-down collapse in the Baltic freight rate may be saying that a global recession is at hand. So we have to wait and see the numbers.
Yeah, besides we have these supply chain shortages where companies like Walmart are hiring their own shipping container freighters to make sure that at least their store shelves are full.
Oh, yeah.
Yeah, so that could be an effect of this supply chain thing.
Yeah, there still is that shortage problem, but I think the Baltic and these other freight rates are suggesting that it's beginning to ease. So, and of course, a lot of the problem in container shipping is the ports at Los Angeles, where it's under the control of California socialists, and they don't, you have to have a certain kind of truck. You have to have this, and you have to be you can't have casual truck drivers. So the politics of California have forced the problem at the ports of Los Angeles, and that is feeding around the world. But so, anyways, the other shipping rates going down suggests that eventually the port crisis in California will ease. Don't know when, but it seems inevitable, Jim. So
the market storm has failed to dent a solid U.S. growth. I think it was something like 6.9% in the last quarter.
Yeah, I pulled that one out because it was saying economists say the financial storm has nothing to do with the economy, and the economy is solid. And I didn't have time, but I've got quotes from October 1929 saying essentially the same thing. You had the initial whack to the financial markets, particularly the stock market, and then, of course, there was then the Harvard Economic Society, which frequently released statements on U.S. economy, and that's a typical statement. You have a magnificent bubble, crazy speculation, you get the first hit, and then the economists all come out and say there's no problem in the economy. So this is essentially, I put it forward because this is exactly what they were saying in October 1929. So we will watch this one very closely.
Well, isn't the problem with the economy, the big companies, if they've been buying on margin, you have to service your margin clerks, and that means perhaps I have to sell a factory or close a factory to make, to pay my bills.
Oh, yeah, everybody gets leveraged in a financial mania. So this is where now the stock market in most of the time has led the changes in the economy. And typically at the top of a bull market for stocks, it'll peak 10 to 12 months before the economy goes. So the S&P will peak and head down. The economy keeps going up. But this is, of course, also the economic gurus put together what they call the leading indicators on the economy, and they put the S&P in the leading indicators. But the problem is that when you're in a financial mania, the financial markets dominate so much that when the stock market turns down, so does the economy. For example, in 1929, the stock market peaked in October, early October, and the economy peaked in that August. And then the previous bubble, believe it or not, in 1873, the NBER also did determine what the business cycle was back then, and you had in New York the stock market peaked in that September of 1873, and the economy peaked in that October. So as close as you can get. So then what we have now is that if this the test of the previous highs on the stock market fail, then you can determine that it's in a bear market, and quite likely you can look over your shoulder and say, yeah, the economy started heading down as the stock market started heading down. So this is going to be very interesting.
And the final headline, it's official. The stock markets are off to their worst start to the year ever, with 3 of the first 4 weeks down.
Yeah, that was a pretty good headline. It's been a very nasty start to the year. Now, there's something also important with January. 1973, the stock market peaked in that January. I think it was January the 10th. And then quietly rolled over into a bear market. So there are other, like gold and silver, crazy speculation in 1980 peaked in January. So sometimes you can have an important high in January, and that's the start of a bear market. So this is where then this headline about a very severe whack, the worst ever, one says, oh, maybe if you got such a hard hit like this, maybe it's oversold enough to rally. Now, it is oversold enough to rally, but I think that the market is unlikely, the S&P is unlikely to go to new highs, and this then could be the start of a bear market. And as I say, it'll take the rally wherever it gets to when it comes in, rolling over, and then you can determine that. So it's highly probable that the bull market is ending. Let's put it that way, Jim.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.